Despite a lower for much longer oil price reality, we have maintained our focus on executing our dual regional strategy here in Southern Africa and in North America. This approach augments our other businesses' activities in Eurasia, the Middle East, and the rest of Africa. Looking first at our Southern Africa regional strategy, we are expanding our interests in Mozambique. In January 2016, we obtained approval from the Mozambique Council of Ministers for our field development plan that will see further hydrocarbon resources monetized to support Southern Africa's growth objectives. With an initial investment estimated at $1.4 billion, the first phase of the production sharing agreement proposes an integrated oil, LPG, and gas project adjacent to Sasol's existing petroleum production agreement area. The Mozambican gas industry is playing an increasingly important role in the regional energy landscape, and this project represents a major milestone in further developing natural resources, which will significantly benefit Southern Africa. In addition, during the half year, we took a final investment decision on the 2.7 billion rand Loop Line 2 natural gas pipeline project. This project will increase gas capacity on the Mozambique to Secunda pipeline to 191 billion cubic feet per year. Beneficial operation is expected during the second half of the 2016 calendar year. Turning to our ongoing and large-scale South African investments, the establishment of our Mpumelelo and Shondani collieries, which form part of our 14 billion rand mine replacement program, will ensure uninterrupted coal supply to our Secunda Synfuels operations. The Mpumelelo colliery achieved beneficial operation during October 2015 within budget. Similarly, the development of the Shondani colliery continues to progress steadily, and we expect to achieve beneficial operation during the first half of the 2016 calendar year. Within our chemicals business, the expansion of our wax facility in Sasolburg is progressing well. As you may recall, Phase 1 achieved beneficial operation in May 2015, and the project is on track to achieve beneficial operation for Phase 2 during the first half of the 2017 calendar year. The total project cost for both phases remains unchanged at 13.6 billion rand. And despite the challenging environment, our contributions to the South Africa economy remain substantial, with an in-country capital spend of 8.6 billion rand for the half year alone. Sasol also paid 18.1 billion rand in direct and indirect taxes and remains one of the largest corporate taxpayers in South Africa. In addition, during the period, we invested 400 million rand in skills and socioeconomic development. This includes investments in our public-private Ikusasa partnership and various bursary learnerships and artisan training programs. Separately, last month, we declared an interim dividend of 356 million rand to our BEE partner, Swarisano, which holds a 25% shareholding in our Sasol oil subsidiary. We are pleased to announce that based on the attractive returns generated by Sasol Oil over the last 9 years, the debt relating to our BEE partner's equity shareholding has now been settled, well ahead of the anticipated timelines. Turning to the second leg of our regional strategy in the United States, significant progress continues to be made on our world-scale ethane cracker and downstream derivatives complex, with $3.7 billion expended to date. Detailed engineering for all process units and supporting facilities is at an advanced stage. Site construction is commenced, with major underground and civil work nearing completion. To support our response plan's lower cash flow requirements, we have taken a decision to pace the execution of the project. Importantly, the proposed shift in schedule will further optimize field efficiency and limit the spend rate. Our view is that a phased commissioning of the cracker and some derivative units will occur in 2018, with full beneficial operation of the smaller derivative units moving into calendar year 2019. By optimizing cash flows, we are managing the company's gearing and credit rating, ensuring continued balance sheet strength, protecting our dividend policy, and driving resilient earnings.